In this video, we're going to learn how to use marginal tax rates to calculate the total tax owed in a given year. So you see we have this list here, this is from 2016, of a bunch of different tax brackets here. We have, the initial bracket 10%, 15 and so on, all the way up to 39.6. Now I do want to point out something. This is a very common misconception on tax brackets, is that even if you happen to be in this highest tax bracket, you make more than $415,000 a year, even if that's the case, you are not going to be paying 39.6% on all of your income. So the way tax brackets work is you're going to pay the percentage associated with only each bracket. So you always will start in bracket 1, and all the money you earn up to the first $9,275 is only going to be 10% of that. And then only the amount over that is going to be at 15% up to $37,000. And only the amount over that is going to be at 25% and so on. And so what that means is if someone made just, $416,050, so they're just $1,000 over that limit there, well, they would only get $1,000 charged at 39.6%. They would not get everything charged at 39.6%. So it's incremental, where only the amount over that bracket you're going to get charged at that higher rate. Now let's actually do this example here. This individual, made $120,000. So the only brackets that are going to matter here are the first 4 brackets, because that's where we get to $120,000. It goes up to $190 in that case. So we're going to work them out one at a time here. So for bracket 1, how much money did he earn for bracket 1? Well, he's certainly much higher than $9,275. So that's going to be the amount counted for bracket 1. And we're going to go ahead and multiply that by the rate for bracket 1, 10%, and we're going to get $927.50. Okay, then we go to bracket 2. And then we need to see how much money did he earn in bracket 2. Well, they certainly earned more than the $37,650. So they certainly earned that much. However, I'm going to subtract off the amount that was counted for the previous bracket, because we were already taxed on that $92.75. So subtraction here is the amount we earned in this bracket. We're going to multiply it by the 15% here. And when we do that, $37,650 minus $92.75, the amount in this bracket is $28,375. Multiply that times 0.15 here, and the amount of tax owed for this part would be $4,256.25. So we're going to go ahead and keep a running total over here of the total amount of tax that we are going to have to pay. And we continue on to the next bracket, which is bracket 3. Now bracket 3 goes all the way up to $91,150, but we've already paid taxes on the first $37,650 here. And we're going to multiply that times the new rate of 0.25. And put this in our calculator here. 91,150 minus 37,650 times 0.25. So they earn $53,500, and multiply that times 0.25. We get $13,375 even. So that's how much they're getting taxed on this bracket. And then finally, we go into bracket 4. Now bracket 4 goes all the way up to $190,000, but this individual did not earn $190,000, they only earned $120,000. So we're only getting taxed up to $120,000. And they have already paid taxes on the first $91,150 here, so I'll subtract that off. We then go ahead and multiply by the marginal rate of 28% here. Let's do some calculations. 120,000 minus 91,150. We get a marginal amount of 28,850. Then we multiply that times 28%, and we get $8,078. So we add that in here. Notice, I want to point out something before we finish up the problem, is that even though this part here, this was in the highest tax bracket, 28% that was calculated for this person, and even though that was the highest percent, it was not the greatest amount of tax. That was the $13,000, which came from a lower tax bracket, and the reason why is there was a greater amount counted in that bracket compared to this new bracket. There was 53,000 counted in bracket 3 and only 28,000 counted in bracket 4. This really illustrates how the amount you earn only gets taxed in the bracket that it is earned in. So again, it's a little confusing at first, but hopefully this makes sense. Now if we go ahead and add up all four of those tax amounts there, we get a total tax amount of $26,636.77. And so this right here would be the total tax liability for this individual at the end of the year. One little quick side note before I end this video is that most people do not get a tax bill of $26,000 at the end of the year, and that's because throughout the year they're having money taken out of their paycheck and given to the government every so often, and that is paying for it, and so you only have to pay whatever is left at the end of the year. So let's say at the end of the year, your job had already taken out $26,000 out of your paycheck to pay the government. You would only have a tax bill of the remaining $636.77. 75 cents. Sorry, I wrote that wrong there. On the other hand, if you had your job take out more money, let's say your job took out $27,000 throughout the year, then you'd have a refund of the $300 or so and change, the difference between the amount you're supposed to pay, $26,636, and the amount you actually paid in your paycheck. And so what I want to just point out here is that means that if you're getting a refund each year, that means that you are having your job take more money out of your paycheck to pay the government each paycheck than you actually need to. The perfect situation is if you had them take out the exact right amount out of your paycheck, so that at the end of the year you will have owed exactly the amount you paid and you'd have no refund and no bill. It's somewhat difficult to have it work out to be that perfectly, but I do want to point out that when you get your refund at the end of the year, it's because you gave more money to the government during the year and they're giving you that extra back. It's not actually just free money.